Hey everyone, welcome to the Note Investor Podcast. I'm Dan Deppen, and today joined by ForrestJinks of Altus Equity. Forrest, how you doing?
I'm doing well, thanks. Thanks for having me on.
Yeah, no, thanks for joining. It was a long time coming. I know we first met like several years ago when I was out in Santa Rosa, so it's great to have you on. But maybe give us just a little bit of background on, who you are and what you do and what you guys do at Altus.
Well, I'm sure we could talk about the background for a long time. As you know, when you've been in real estate for a while, the time goes by very slowly, sometimes on a daily basis. And you look back and you're like, crap, I've been through all these recessions, I've been through all these cycles, and here's all the scars that I have to show. And, like, I mean, I don't feel like I look that bad for being 28 years old, but
Yeah.
so I kind of fell into real estate right out of college. Had a corporate job, but wanted to buy a truck, but knew if I had a finance degree, if I bought a
Mhm.
truck, then I couldn't buy a house. So I bought a house. The only thing I could afford was a fixer upper, fixed it up, split some land off, you know, learned how to do construction, learned how to do all these things at a very property level, I would say. Like I literally have jacked up houses and fixed foundations and done roofs and all that stuff myself and managed, rentals myself. But over time, it grows, you pick up a couple investors. We did, got into different types of real estate, doing retail renovations, condo conversions, infill subdivisions, note purchases. Like,
Mhm.
we were the very stereotypical real estate cowboy where the business inside and out. You don't really know how to scale it, but every great opportunity that comes along, you figure out how to do it because you can underwrite to value. And so
Mhm.
that kind of led us up to 2008. Really, it was 2007 that things got real ugly. By
Wow.
2008, towards the end of 2008, things started turning around.
What part of the country were you in? That was in
Um,
California or
my portfolio at that point, my active portfolio was in California, so we were doing probably three retail repositionings, renovations, lease ups, or new construction. There was a office condo project. There was two residential condo conversion projects. These weren't ground up, these were conversions. Five or six or seven infill residential projects. Those were mostly in California. I had some stuff, small stuff in Arizona, but then I had a bunch of rentals in Nebraska,
Mhm.
uh, homes and some apartments there. Yeah, so the Nebraska stuff did okay. California was like an atom bomb went off. It was really, really ugly. I was totally insolvent, done.
Mhm.
Couldn't even afford to hire a bankruptcy attorney, frankly. But
Yeah.
didn't go bankrupt. Came out of it way upside down. And it's like I can't get a job because for the last 8 years I've done nothing but real estate, and I owe tons of people money. So if I go get a job, I'll never be able to pay them back. So what am I going to do? Well, I guess I got to do more real estate. So jump
Mhm.
back in and have been building since then. But also really wanted to do it different the second time because I didn't want to have the same things happen that happened the first time. One of those things is I think people oftentimes make a mistake in thinking that doing a real estate project is the same as investing in real estate. And
Mhm.
so through my effort and through my sweat, blood, tears, personal guarantees, all that, I can create really, really great returns. But I'm not just investing money. I'm getting paid for those things that I'm bringing, whether it's expertise or time or guarantees or whatever the case is. So 2008 really made that clear. Like in my mind, I've got to separate those things. I do want to invest in real estate. I think it's a great real estate asset class. I want to invest in notes. I think it's a fantastic investment class on a risk adjusted basis. But I also want to get paid for my expertise, which could be
Right.
a development, it could be consulting, although we don't really do much of that, but it could be a lot of different things. So I had to make sure that I separated that in my mind and how we did our business. And then really we wanted to be a true business. Before I didn't want to be a business. I wanted to be a guy that controlled my own schedule. I had these developments going. The only thing I ever had to show up to was city planning meetings.
Mhm.
I could, yeah, I mean, architects and engineers and that sort of thing, but really it was the city planning meetings. once you have a real business, it's not like that anymore, you know? You've got people,
Yeah.
you've got responsibilities, you've got investors, like there are things you have to do. So there's pros and cons, but that's the way that
Yeah.
we went since
It's
then.
funny how that works, right? Because I'm self-employed too, and have investors I'm obligated to. And then, before we talk, let's talk about some of the new stuff I've been doing that I'll be talking about in the podcast later on. Yeah, and it's like you're doing stuff day and night. It's like, yeah, I'm self-employed, I can do whatever I want, but I'm like the biggest maniac of a boss that I've ever had. So it's not it's not always what people expect.
Yeah, I actually don't feel like I am self-employed anymore. I mean, I have a job as a CEO. I
Hmm.
get paid by the company to be the CEO. And am I an entrepreneur? Yeah, I'm still an entrepreneur. Am I a business owner? Absolutely. But I have responsibilities now to investors. You know, we have, I don't know, call it 35 different entities we have to report on quarterly.
Hmm.
Those entity docs tell us when we have to have our reporting done by. Like that's not an option, you know, that has to be done. We do quarterly investor calls. That has to be done. We tell our investors that we are going to get back to them within 24 hours, no matter what. Well, what if our investor relations person is on vacation? That has to be done. So one of his staff might be able to do it. Maybe they don't know the answer. You know, we have employee issues. We've got all those things. And uh, this is not a complaint, by the way. Like I live a great life and I'm really
Yeah.
happy to be a CEO, but it is different than being, you know, kind of a self-employed in my mind from that perspective. I hardly ever play golf anymore.
Oh, that's too bad. I still make time for golf. I think I
Good for
plan
you.
that first, and then yeah.
My kids are young still, so 7, 10, and 12, which means, you know, today my daughter has a junior high volleyball game. I'll leave the
Hmm.
office at 2:30 to get there, you know, watch the volleyball game, and then go back to work. So it's not like there's not flexibility in the schedule, but I can't play golf and go to the volleyball game, right? So
Right.
yeah, so when the kids get older, I'll be back to golf maybe.
Yeah, there's only so much time in the day, so. But then I think you mentioned too, like you do some stuff and there or some of your deals involve distressed assets. Maybe you talk about that a little bit.
Yeah, well, you know, for many years, well, let me go back. Coming out of 2008, everything was distressed.
Hmm.
Um, I really wish I knew then what I know now, because pretty much everything we touched turned to gold starting in 2008. I just wish I would have touched way more things and way bigger things. But there was a
Yeah.
kind of a ramp up. There was lots of scars from the experience. Um, you know, we had never really raised money before. And so trying to find investors, all that stuff, if we could take our investor group and our experience now back then, I mean, it would be great. But let's say somewhere around 2012 or 13, up until 2022-ish, there really wasn't a lot of distress. There would, you know, you
Hmm.
still have the 5Ds, death, divorce, dismemberment, what, you know, whatever those are. And so we did find it once in a while, but really we were adding value for the most part, as opposed
Hmm.
to finding value. But in 2022, it was very obvious that distress was coming. And so we pulled back from the market. We did not buy a single property for 2 years. And we spent that time putting together two funds. One is a non-performing notes fund, and
Hmm.
one is a what we call an opportunity fund that includes distressed debt as a small component of it, but also has distressed real estate in it. So a couple months ago, we bought a 350,000 square foot industrial property vacant for $12 a foot.
Hmm.
Well, I know it's vacant, it's scary, all this. We paid $12 a foot. Like you can't hardly pour concrete for $12 a foot. Oh, and by the
Wow.
way, we got 40 extra acres with it for lay down yard and for future, you know, new buildings and stuff. So I love distress because it really comes down to intrinsic value and then the creativity of how do you solve the distress. Sometimes it's financial, right? Like it's just, hey, this person's debt's way screwed up. The property's fine. you fix
Yeah.
the debt issue and you got a good property. And that's really how it was coming out of 2008 in a lot of cases. We bought lots of auction properties, some multifamily, a lot of single family. Um, you bought it, you owned it, it was a good property. Maybe you had to clean it up a little bit, but it wasn't like you were reinventing the wheel. There's
Hmm.
other types of distress, like the one I just mentioned, that the distress is that it's vacant. And what are we gonna do to fill it up? And how are we gonna demise it? And how are we gonna overlay one tenant that builds diesel engines with another one that wants to put in a pickleball
Yeah.
facility?
Those
You
are
know, like,
common. Those are all over Colorado. Yeah. Those are,
yeah, they're great. I think it's a great tenant. I mean, we're very excited about working with them, but you don't want the pickleball person next to someone that's working on diesel engines, from a sound
yeah.
perspective. And
That's not a good fit. I've only played pickleball once, and there's this place in Boulder, and they had the pickleball place, and then next to it was a brewery. So that was like a perfect
yeah,
setup. Yeah.
because you're yelling anyways in the brewery, right? So the
Yeah.
talk, yeah. But then, on the debt side, I think that there's a lot more coming. But the distressed debt has been starting to trickle out a little bit. So we've got, I don't know, 40 or 50 loans so far,
Hmm.
most of them smaller loans. But we've had great success in resolving them so far. We've had some larger commercial loans that we felt like we were right there to purchase it, and either the seller or the owner of the property was able to resolve it, or something happened. But we do feel like there's more of those going to be coming along. And yesterday we put in a bid for I think 100 HUD, single family HUD loans.
Oh,
Uh,
wow.
so there's stuff out there starting to loosen up. And
Yeah. I mean, it seemed like after COVID, everybody was waiting for this wave of distressed commercial notes to hit the market. And I don't really play in that side of the world, but I'm curious, like, are we starting to see that yet, or is it still kind of waiting for that?
um, yes and no. So the distress is for sure there. I mean, we're looking at properties, because we have both the equity side and the debt side.
Hmm.
So on the equity side, we're trying to buy multifamily, for instance. We love multifamily right now. Everyone's afraid of it because rents are stagnant, insurance costs are up, prices are
Hmm.
dropping. There's markets where we've seen prices that are down 50%, I kid you not, in the last
Oh,
two
wow.
years. Houston, Houston.
Yeah.
Um,
That's like a hurricane zone too, right? Like it's,
yeah, so you've got all these factors playing in, and the lenders, we're looking and we're saying, wait, we can't buy this property from you because, well, one in Texas, they wanted 114 million, the seller did, and they wanted some blue sky, which means they wanted to be able to make some amount of upside in the future based on how the project went.
oh, yeah.
But the loan itself was 114 million. Well, we got on with the brokers. We loved the properties. It was a two-property portfolio. We really liked them. They were not being managed well, 78% occupancy, but only 10 or 15 years old. And we had the brokers walk us through their pro forma, and we're like, well, you realize that if someone is successful in executing your pro forma, it's a 3.5 cap. Like, that's what we're stabilizing to.
Mm.
Like, where does that make sense? That's not going to work for anybody. And they're like, oh yeah, I guess not. So our
Hmm.
underwriting price was 70 million on a $114 million loan. The lender won't even return our phone call, right? Like, they still think the property is going to be worth 150, 160 million. Well, it may
Yeah.
be someday, but no one can pay the debt right now because the property's not producing enough income to pay it. I I talked to someone I know in the industry yesterday, and we were kind of trading war stories, and it turned out we both looked at that property. They
Uh-huh.
underwrote it to 92 million, by the way.
Okay.
So our underwriting may have missed something, or theirs may have missed something, but 92 is still a lot less than 114.
Yeah.
So the lenders just aren't acknowledging yet, but at some point they're going to start acknowledging it more. I think where we are starting to see it is in the regional banks.
Okay. Now, are those people, are they just maybe anchored on what number they need to get out from under it as opposed to the actual value to the buyer? Or
I think so, but I also think, you know, thinking back to 2008, I don't know if you were in the industry yet then, but there
no,
was
I
different.
wasn't. All my money was in stocks, but I remember it well. Yeah.
Well, as the distress wave came through, there were different actions taken within kind of the segment of where we were in the cycle. So in the early stages, and this would be, 2007-ish, really, when people really started realizing that real estate was in trouble, at least on the coast. This FDIC told banks, you cannot extend. So, especially on redevelopment stuff, you have these 2 or 3 year terms, and then if the
Mhm.
project's going well, they'll extend them, and then once you get it done, you can take it to perm financing. Well, these balloons come up very quickly on these projects, and the
Yeah.
banks were not allowed to extend, even if they were current on their loan payments.
Oh,
So all of a sudden, we're like, hey, like we've been paying you, we still have interest reserve, we still have a good project, and like, sorry, we cannot extend. So that made for huge discounts because you had to do something very quickly, right? But
mhm.
then it wasn't a whole lot later where the FDIC said, never mind, please extend and just pretend like it's not there as long as you're getting payments or as long as you can make it
Right.
work. And so that happened for quite a while. And some banks rode that out all the way through. The FDIC would get on them, they would work it out, they'd get on them again. They had regulators in their offices pretty much every day between state, federal, whatever the case was. But they wrote it out and did pretty well in the back end because they were able to recapture all that as values came back. But a lot of
Yeah.
banks started liquidating during that time period. Right now, the whole extend and pretend thing is on the front end.
Yeah.
The FDIC thought, that worked okay. Go ahead and do that now. But what
Mhm.
they're, I think, forgetting is when they did it last time, we were already well into the cycle. And if you do it at the very beginning, how long can you extend without collecting interest? With having a property that no one's maintaining because there's no incentive to
Because it's
maintain anything.
vacant.
It's vacant, or
Yeah.
the apartment owner says, well, I can't even pay my debt. There's no money left over for improvements, so I'm not gonna, if someone moves out, I'm just gonna leave the unit vacant. And so the
Yeah.
properties start degrading over time.
Mhm.
So I think that some of the regional banks are starting to see that and they're wanting to take action. The debt funds are less so. Um, they just don't, if they acknowledge that there's a problem, then they have to start doing mark to market. They've got to start doing reserves and
Yeah.
things.
Yeah, and it's interesting how long those things can actually take to play out. Like I moved away from Florida, I think in '04, and I think Florida started to melt down. Like I think like '05 was like the beginning of it. So
Hmm.
till they went like all the way through that cycle, it was years that went
Oh,
on. It was not a fast thing.
and we talk about that internally all the time. It's like, well, did we miss the boat? Is there really not distress? Like we did all this work to get ready for distress. And what, did we miss it? And then you see, no, it's still coming. Like it's still out
Hmm.
there. But then you go another month or two and there's some good news that you see and you're like, oh, did we miss it? Is there not distress? And then you see that, uh, delinquencies have gone up by 10%. Like, nope, it's still coming. It takes a long time to play out.
Yeah, my theory on that stuff is there are a lot of things that you can predict what's going to happen. Like, something is not sustainable and it's not going to last, but it becomes really hard to predict actually when
Mhm.
things are going to turn around because stuff can drag out a lot longer than you think. Like I've even seen situations in like W-2 jobs I've had where like this whole project, this whole thing, this is not sustainable. Does not make sense. Like this is not going to work, but yet everybody's going along. And then eventually the rubber always hits the road at, at some point. So,
Well, too, I think if you look at especially the debt funds, my belief is that most of the debt distress is going to be the debt funds because they were the most aggressive on a lot of
Mm-hmm.
things. Most of those debt funds are new since 2008.
Mm-hmm.
And so, you know, a lot of people in the industry are a lot younger than I am. Kind of like yourself, you weren't in
Yeah.
the industry in 2007, 8, 9. They
Mm-hmm.
haven't had that experience yet. So we had one debt fund that we've done some work with and that has a portfolio of non-performing loans. We got in touch with them. They're backed by a private equity group. We got in touch with the private equity group. Private equity group said, hey, debt fund, give these people your non-performing notes so they can make a bid on them.
Uh-huh.
They sent it over. We responded and said, okay, where's your bid package? Like, what day is the bid? We need the notes. We need all these things. You know how that works. Like, you have to have
Yeah.
data, otherwise you can't put together a bid. A couple days go by, we follow up. They said, okay, we'll get it to you. A couple more days go by. And then they said, you know what? We're not going to sell them. And what it really means is they don't know how to sell them.
Yeah.
They've never had to sell a note before. And so eventually that's going to work itself through. I think in their case, they might try to take everything to foreclosure themselves.
Mm-hmm.
Maybe, maybe not. Maybe they're going to try to figure out how to sell notes, and then we'll hear from them again. But
That's all too common. You know, when people are selling individual notes on residential properties, and sometimes even people who have sold notes and know how to do it. Like it's amazing how many often I'll get a tape or somebody will send me stuff and the information's way incomplete. And it's like I can't do anything with this. Just give me all the info. I'm not going to go hunt for it
and
myself.
you know, too, because there's been like if you're a servicer, you buy and sell servicing rights all the
Hmm.
time. If you're a big lender, you know, you're buying notes, putting them into pools and selling them off in tranches and bonds or whatever. But when you get down to smaller individual notes, buying and selling the entire note, there just hasn't been that much of it for a long time.
Yeah.
And so even title companies, escrow companies aren't super familiar with it. You know, we know a fair amount about lending. We have a lending arm that does private notes. Every time we do a note purchase, we still have some of that insecurity about the process because it's a different process, right? Like, are
Yeah.
are we sure we have insurance on this? Like, title insurance? Are we sure we have the Forrest Place backup insurance in case the borrower's insurance lapses? Are we sure? Like, all these things that are not big deals in and of themselves. It's just that when you're not doing it on a super consistent basis, it's, you know, not as smooth as it might be otherwise.
Yeah, that's hard. Like if you're doing something all day, every day, well, then it becomes pretty straightforward to build the checklist, build the procedures, and you know you have everything covered. But where it's a little more of a one-off or something you haven't done in a while, I know what you mean. Like that can be a little bit trickier. But it always boggles my mind how when someone's trying to sell a note, that they don't make it as easy as possible for the other party to buy it, right? It's the same thing if I'm selling. I want to give them everything, make it easy for people to sell. If I'm buying, like I want to be super squared away so that, you know, you're easy to transact with. It's not unlike you know, other forms of business, right? Like if you have a customer, you want to make it as easy as possible. If they get confused, they're going to be away. If there's friction, they're going to be less likely. But that doesn't always translate, it seems like, when people are selling notes.
So we worked on a note purchase from it's a public bank, but it's a kind of regional bank just a couple weeks ago. It took us almost 3 weeks to get the NDA in place because we're buying one note. I
Hmm.
know, like, they introduced me to the borrower. The borrower said they could give me the loan docs. They got like an email in writing, but they still want the NDA. But the NDA came with all this stuff about us never hiring any of their employees. I'm like, I don't really
Okay.
care. I
Okay.
don't want to hire your employees, but I have no idea what happens down the road. Like, I don't even interview all the people we hire. I don't want to be on the hook 5 years down the road when we hire someone that's worked at another job in between, you know? So it was like this risk they were putting on us, but it was silly. Like so we worked through it, but it was just was friction that didn't need to be in the process. And
Mm-hmm.
then we reviewed everything. We went through, we pointed out some stuff to them where their numbers were wrong just based on how the laws had changed since they'd done the notes. We made our offer, which by the way was at par. It was at the principal balance of the loan, which if you have a loan in distress, that's pretty darn good.
Yeah. Oh, no, was this residential or commercial?
It was commercial.
Okay.
So our offer was we bought the loan at the principal balance.
Mm-hmm.
The bank lent us a big portion of the purchase price, but we got to keep the back interest.
Yeah. So there were arrearages on top of that. Yeah.
Yeah, so we got the arrears. We were able to borrow money for them cheaper than the interest rate, and so we were going to at least make a spread because the borrower was almost certainly going to go through bankruptcy. But
Mm-hmm.
separately, we were working a deal with the bank with the borrower to redo their note under a forbearance agreement, give them more time at a higher interest rate. So we were like, really, the spread is where we were going to make some good money.
Yeah.
But the default interest was like $750,000 or something. It was a big part of what we were buying, and they came back and said, no, we need the entire principal balance plus all penalties, all fees. And I said, so what exactly is our motivation to buy it in that case? So you don't want it because you know he's going to go to bankruptcy.
Mm-hmm.
So you want to sell it to somebody, and we're okay with that, but you want us to do it basically for free.
Yeah.
And so obviously that transaction didn't happen. And they acknowledged that, yeah, okay, I get it. Like I know we know why you're not buying it, but
Yeah. I had one time where, and this was through a pretty popular broker. He had this note and he's like, this is what the seller wants. And I did the math and it was like a 4% return, like with risk. And I was like, this doesn't make any sense. And I was wondering if I missed something, so I emailed him. I said, well, here's how I looked at it. So what I'm getting, like, can you help me out? Like, did I miss something? And then he just didn't respond. But yeah, sometimes people,
that happens a fair amount actually. And I love the approach of, hey, can you help me out? If I'm missing something, I want to know.
well, yeah. And I was trying to be nice, right? Because I have been known to have brain farts sometimes, right? I'm like, maybe I did miss something, but yeah. And then
And
he didn't talk to me much after that.
even without brain farts, we still miss things. Like
Sure.
these are math, it's math. These are models. They break, something got hard coded at one point. It's supposed to be a formula. Like it happens. So, we got to be very careful in running things through the models and doing litmus tests on, does this really make sense? But if it doesn't, I want to make sure it's not on my end that is not making sense because I don't want to miss a great opportunity.
Right. Cause that can happen. So,
Absolutely.
well, cool. Well, that's probably a pretty good stopping point. So Forrest, thanks so much for joining. I really appreciate it.
Talk to you again. It's been a few years, so wonderful to reconnect.
Yeah, definitely. And how can people get a hold of you?
Uh, altusequity.com
Mhm.
is the website, ALTUS equity.com. Both of our existing funds are on there with links. We also have active qualified opportunity zone investments that are open. We do have more passive I shouldn't say more passive, but we have LP investments as well in individual deals on occasion. Not as often under the current kind of structure. We do, like I said, we broker private debt. If you want a more stable kind of lower risk type thing, we like to think of that as our bond portfolio, 9,
Mhm.
10, 11, 12, 13% returns, usually first position, but we do some seconds as well. And if you want to email me directly, it's fjinks@altusequity.com, and you can reach me through the website as well. So happy to talk to anybody, even if it's just talking real estate. I love talking real estate, love talking investing, and happy to connect.
Cool. Well, thanks again. Appreciate you coming on.
Yeah, thank you.
All right.